Hey everyone, this is the second lesson of Ethan Trade Stocks. Today, we will learn about stock market facts and commonly used terminology. First of all, when can I trade on the stock market? The market opens at 9:30 a.m. Eastern Standard Time and closes at 4 p.m. Any time outside of the stock market hours is considered after-hours trading. It is important to note that not all stocks support after-hours trading. And if a stock is purchased after hours and it does not support it, your trade will be executed at the open of the next trading day. Especially on weekends, the market is fully closed with no exceptions. So this means if you buy a stock on Friday after 4 p.m., you have to wait until Monday at 9:30 for it to be executed, and the price would have changed from then. This is an example of what a stock's information and graph looks like. You can see the previous close, the open, the market cap, and you can see the EPS and the PE ratio. We'll be covering these terms and much more in the slides below. The open is the price of stock at the day's open, and the previous close is the price of stock at the previous day's end. The difference between the open and previous close gives you how much the stock changed after hours. As an example, if the open was $5 and the previous close was 4, 5 minus 4 equals 1, so the stock went up $1. If the open is $5 and the previous close is 6, 5 minus 6 equals 1, so stock went down $1. The volume is the number of shares traded on a certain day. And the relative volume is an indicator that tells traders how current volume is compared to past day's volume, and how that volume is compared to the total shares a company has. Day traders use relative volume to help them find which stocks to trade on a given day. If a stock is trading at very high relative volume, it means more shares than usual are being traded. Therefore, the stock has very high interest, less supply than demand, and some sort of news coverage to attract so many people to it. These are the types of stocks day traders buy. The total shares outstanding, also known as float, is the number of shares a company has issued, and that can be traded on the stock market. Large float companies, you can get in and out very quickly. There's so many shares and there's a lot of volume that you can buy and sell and you never have to worry about being stuck in a trade. They're very predictable. If you know something, they're going to come out with a good product, or they're going to have a really good earnings statement, you can know whether or not they're going to go up or maybe they're going to go down. The stock price usually changes very slowly. So this is very important to note because you know that overnight your money just won't disappear. Small float companies, usually ones that day traders focus on, sometimes there's a delay between the button press and the execution. So that means if you think you're buying a stock at $4.81, you might actually be buying it at $5. And they're very volatile and influenced by volume. So if they go up and down based on volume very, very drastically, they have huge intraday moves. And market cap, otherwise known as market capitalization, is the value of a company. You can get this number by multiplying the price times the float. The dividend yield is a percentage of a stock price that is paid out per share yearly. The money is paid out quarterly, which is every 4 months. As an example, a $100 stock can pay a $5 dividend yield. This means that every year, each share pays out $5 to its owner. And a really good question is to ask yourself, why do companies pay these dividends? It's like free money. They do this to reward their shareholders for sticking with them and believing in the company, and to incentivize their shareholders to hold on the company stock when the price drops. So if you bought a stock at $5 and that drops to $4, you might want to get out of that stock and sell it for the loss before it goes down more. But if they're paying you a dividend yield, then you could make that dollar back. You can make your 25% back. Earnings per share, EPS. It's the earnings of a company divided by its current outstanding shares. And a PE ratio, price to earnings ratio, is the share price relative to the earnings per share. This helps investors realize the market value of a stock compared to its current earnings. Usually, investors like to keep the price 23 times the earnings. If you're paying $100 for a stock and its earnings per share is only $1, that may not be the right stock to invest in. Thank you so much for watching. I hope you guys really enjoyed this video. Please like and subscribe. It really helps me out, gives me a lot of motivation. Thank you guys for sticking with me. Bye.